All right, Happy New Year. If I can still say that, probably close to the last day to say Happy New Year. It's getting a little old. But Happy New Year from the Presidio Perspective. First time on the airwaves in 2023. Back in the studio with Dave, Chenet, David on the ones and twos. We want to talk about markets, give an update where we've been so far this year. It's been a little bit better year, at least since last year for sure. And of course, our recession watch. Is it soft landing, hard landing, headwinds, tailwinds? So let's get into it. Dave, good to see you again, my man.
You too.
Yeah. So let's jump into it, dude. So, here we are, 2023. Different story so far than what we had last year, which is, to your credit, something you said we might be able to expect. But let's just talk about some of the raw numbers that we've seen, a little market update, and then kind of get into what's going on maybe.
You nailed it. A good break from what we saw last year.
We needed it.
It seemed like both bonds and stocks were selling off at the same time.
Yeah.
The great thing this year is we've seen that work towards the upside, right? Both bond markets and stock markets have done well so far this year. And I think the story is twofold.
But really kind of the end of last year it started, right?
Right.
It was kind of like November, it felt like, when rates started coming down. And, we're kind of wondering, I was wondering, you get that little relief rally, they call it the Santa Claus rally. You kind of see that after a bear market going into the year. We see that in most markets, kind of the Santa Claus rally. And then you just wonder, we're all talking about recession. Do we just give it all back immediately in January?
So it's been the narrative last year was, what's the Fed going to do? Are they going to tighten too much? When will they have to stop? When will inflation come under control? And I think we've seen some of that. We've seen a lot of good, positive inflation numbers, meaning that a lot of the work that they had to do to control inflation looks like they've largely done their job. With that said, we're still looking at inflation with a 6 handle, so more work to be done. But looking at some of the month-over-month and quarter-over-quarter numbers, much more closely in line with the Fed's 2% target.
Yeah.
At the same time, we've seen a little bit of reopening from China which markets have really loved.
Yeah, I mean, if you look at, the data so far year to date, and you look at the asset classes, we have emerging markets kind of leading the way. The EFA, Europe, Asia, Far East, kind of more of the developed markets, pretty much right in line, right? Kind of both finishing up about 7.5%, whereas the S&P is up only about 2.5%. So and pretty strong outperformance so far year to date internationally, which is another bell you've been ringing, for at least the last couple of quarters.
Was kind of the story of last quarter too. If you look, the S&P 500 bottomed on October 12th of last year. And since then, the MSCI EFA...
Sorry, that's my new sound effects for the Presidio Perspective. Dave Chenet just called a bottom of the stock market on October 12th, 2022. So
I'll stick with that.
Yeah.
I'll stick with that.
Awesome.
But to your point, EFA's been the best performing area of the stock market since then, right? Europe's really was beaten up very badly, but is the best recovery since that bottom.
Yeah. It's kind of, the true value play, right? International. It's like, how low can these multiples go, these valuations for paying for, fair companies at great prices or good companies at great prices, right? That old kind of Berkshire model. So you've seen some outperformance. What hasn't been working since then?
So really it's been... everything's been kind of going up pretty steadily since then.
It's all been up, but we're still seeing this big divergence between growth and value, right? I mean, it's still, the growth story is not working. If you look at, the Nasdaq since that date, it's up 6%, whereas what you look at the value, S&P value's up 16. It's a 10% differential. The Dow outperformed the Nasdaq last year by over 20%. I don't know the last time that's happened. It's very rare that's happened in the last 2 decades. But I mean, a 20%, differential in return.
Yeah.
I mean, that's pretty significant, and it's not done, it looks like.
But to be fair, after a number of years in which the NASDAQ virtually outperformed every other asset class in the world.
Good 20 years or so.
So I think it's tied to the rate story, right? In a low interest rate environment, those growth stocks, those tech stocks tend to be the ones that perform the best.
But we've seen declining rates since October 12th. We've seen a fall in interest rates, right? So yeah, it's kind of has to go low and stay low.
I think the question in the
market's
market's
still elevated, right? We're still having, like you said earlier, a 6 handle on inflation. So again, when you're investing for growth, you're talking about money I'm going to make in the future. And if that's discounted at a 6% rate, it's going to be worth a heck of a lot less than if you're discounting it by 1 or 2.
Exactly.
So as long as inflation's elevated, those are going to still struggle. And if you can go and make 4% in a savings account, you're going to struggle to say, why would I go take all this crazy risk to not get paid for 10 or 15 years? Right? And so that's where the companies that make money are still in favor, that trade at lower prices and multiples. And that's what we're kind of seeing out there, right?
Yeah, agreed. And I think we're relatively early on in that process.
So do you attribute the outperformance international and emerging markets? Is that like, what percent of that is the reopening of China, would you say?
I think that's a good catalyst. I think that's part of it. If you look at the U.S. economy.
Why would that matter to Europe, that China's reopening?
So they're more geared towards China than we are, right? The U.S. is, call it 75%, 76% based on U.S. consumption, how much you and I go out and spend on goods and services.
Yeah.
If you look at Germany, for an example, they're about 75% export-oriented, their economy. So as global growth improves, as a country like China, which is the second largest GDP in the world, starts to open up, and those Chinese consumers are able to now consume things that they weren't able to consume for a number of years because of the shutdown and the quarantine. Some of those countries and companies that are more geared towards that international trade tend to outperform.
Their exports are going to China.
Correct.
Yeah, that makes sense. And probably for other emerging markets. Yeah, interesting.
I think another story that we haven't really touched on yet is a lot of the really bad news had been priced into Europe. If we think about a few months ago, the Russia-Ukraine energy crisis, people were expecting a severe recession in Europe because of the energy issues, and we're seeing energy inventories higher than they were last year in Europe. We're seeing a little bit of a warmer winter, which has kind of been incrementally good news, right? Not great news yet for Europe, but less bad than what the market had expected.
Yeah. Okay. So you're telling Germany global warming saved their economy. No, I'm just kidding.
Right.
Just kidding. Calm down, everybody. We're not getting political over here. Oh, that's good. So if we're still talking about going into a recession, though, right? And so a lot of people can say, is this a head fake, or where are we, and when are we gonna, maybe we've hit the bottom in October, right? That's definitely a possibility. Maybe we can go down further. Maybe I want to wait this out. So I think a lot of people still think about that, right? It still seems like, okay, it's starting to go up. We've had a few months strung together of some good news and some positive momentum. Rates are coming down. We've also had a lot of negative news coming out of there, right? You've seen housing start to roll over.
Mm-hmm.
The real estate market's all but frozen. Mortgage rates are high and staying high and not coming down anytime soon, right? You start to see the job cuts going on and being announced. So, what do we say to those folks?
So I think it's really interesting. The first thing I would do is take a look at what's happened in prior recessions. We know that the stock market tends to lead the economy by 6 to 9 months. So what have we seen in the stock market? We saw the S&P 500 fall 25% last year. The chart that I sent out, if I can put a plug in for the chart of the week in last week's email, if you look historically, if you were to buy the S&P 500 after 25% pullbacks, just blindly put money into the market after it falls 25%, if you fast forward a year from there, you'd be up on average 19% with a 90% success rate. So 9 times out of 10, you'd be positive.
Money. Okay.
And you'd be up almost 20%.
So those of you that are viewing this, we have an example that we're putting up here. So this is what Dave has just described. So going back since 1940, there's been 10 drawdowns of 25%. Now, how much did we draw down by October 12th?
Just about that, 24.6%.
All right, so we'll round, right? Rounding to the nearest.
We'll call it 25.
We'll call it 25. And so that's saying that on average, from that date, 12 months later, you made 19% on average, 19.1. If you look at the average of those 10, 9 out of those 10 were positive. Okay, we all know that 1 out of 10 that wasn't. In the 3-year annualized, you're averaged a 10% return
per year.
Yep. Annual. That's pretty good. Again, 90% confidence rate, 89.
Yep.
5-year, 100% of the time. Got to feel pretty good that 10 out of 10 times you made money and you averaged 10%. So that's your fear gauge, right, of what you're expecting. It's really important for investors to have that long-term view, right?
It's hard to do, though, isn't it? When the market's at its bottom, that's the hardest time as investors to put money to work, to take a little bit more of a constructive view.
Yeah.
But history tells us that that's often the most rewarding time to take that constructive view.
And since October 12th, how far up are we?
About 10% on the S&P 500.
So you already got 10 of it.
Yep.
Right. So you're jumping in now, and you got on average another 10 to go.
Yep.
Okay. Till from here till October. But yeah, we'll see. It's a good thing to note. I'm really glad you kind of shared this, because it's just, this is going to happen over and over and over again, right? I mean, if it's 10 times over the last 80 years, so once every 8 years you have a 25% correction on average, some of them even closer together. So just remember this: whenever you see that number, it's a pretty good time.
I think maybe part of the challenge is we know academically that recessions are part of the business cycle, but we haven't really seen a recession. We saw the very short,
the shortest recession
but severe
in history
during COVID.
Yeah.
But before that, you've got to go back to the 08-09 financial crisis.
I mean, that's still present in people's minds, because that was just such a bad one, right? Kind of second to the Great Depression only.
Right. So when people think depression or recession, they think the global financial crisis. But history tells us that not every recession is as severe, and not every recession is as damaging to asset markets.
So you shared this with me, and I want you to go over this next slide. And for those of you viewing, we'll kind of put something up, but we can kind of talk through it. So this is the study of the 10 recessions, right? So not the 25% pullbacks that could be pretty correlated, but here's 10 recessions that we've had since 1957.
Correct. The last 10 recessions.
The last 10 recessions. Okay, and so what you see in recessions is usually before and during the beginning potentially is a drop in the stock market and all asset prices typically. But let's just say the stock market. And what drives the price of the stock market is earnings, right? So what are the companies making? And what is the multiple? How many times that earnings, that 1 year of cash flow, am I willing to pay for this company?
Yep.
So when growth is in favor, when I have a really confidence in the future, I will pay more, right, to buy those future earnings of that company. When we're in a recession, the future earnings are murky, we're not sure, we're going to pay less. It's more uncertain of how much money that company's going to make, or when it's going to make, or if it's going to make it. So when the stock market goes down, one of two things is happening. The companies are making less money, and or folks are willing to pay less for the money that they do make, right?
Correct.
Okay. Same thing with your rentals on real estate or whatever, right? If you own a rental property, that is, the price of that is mainly driven by how much rent you can get, right? So if you can't, if the rent goes down, the home value is worth less, right? So that's kind of the same thing to think about at the stock market. So here we are, the 10 recessions. So what are you measuring here? It says EPS degradation. So this first chart is on the last 10, what is the average decline in earnings from the companies is this the S&P 500?
S&P 500.
Okay, great. So what do we find?
So on average, the mean is about a 16% pullback. Now,
so a company's made $100 before the recession. Now that company makes $85.
Correct.
Gotcha.
Correct. But a lot of deviation there.
Yeah.
The numbers go from the worst we saw was a 50% degradation in the global financial crisis. And there were one or two where you actually saw earnings increase during that recession.
Yeah, I see that in the 70s and 80s, so kind of during those inflationary periods. So you had a recession without earnings going down.
Right. But on average, call it a 16% decrease in S&P 500 corporate earnings over the recessionary period.
So 8 out of 10 times you found a decline and in earnings, okay? And then the PE compression. So this is what we find 10 out of 10 of the times. And every time in recessions, people will pay less and prices will come down.
Correct.
And that's just, we all understand that. Fear of greed and pulling back, less buyers, supply and demand, prices come down, so people are paying less. So what do we find the average kind of results to be over 10 recessions?
So average there is about 25% PE pullback.
Okay. And again, the worst in the financial crisis. Oh, in the 70s, actually, you had a 62% pullback. Murky times. So then you look to the S&P 500 drawdown during recessions. In these last 10 recessions, what do we have?
So last 10, the average was about a 30% drawdown.
And these are all pretty recent numbers, right? These were historical. Gotcha. These are historical. So tell me where we are today. So on average, you're going to, in a recession, you see earnings decline by about 15%. You see compression of about 25, and you see a drop in the stock market price of about 30. So let's layer on where we are today in this market.
So far we've seen multiples fall, right? We've seen that risk off trade and people reduce what they're willing to pay per dollar of S&P 500 earnings. Multiple went from almost 25 to the low of mid-16s. So a fall of just over 30%. So right in line with what we would expect from that average price to earnings multiple compression.
Okay, more than the average, right? The average is about 26, and so we saw a 30% pullback. I think 30% is kind of where we are today. Maybe it was even worse.
Yeah.
Okay. And then a price decline of about 25 at the worst, right? So, we're at 31 is kind of the average, but certainly we've seen ones that haven't pulled back more than 25.
That average is a little misleading. If we look at the 2001 and the 07 to 09, those
50 and 56 kind of,
those big numbers pull down the average. So I think we need to ask ourselves, is this a economic depression? Is this going to be an 07, 08 severe global recession? Or is this just kind of more the run-of-the-mill recessions where you've got a brief slowdown in growth and then we recover?
Yeah. Okay. So it's going to take some kind of event, some unknown, I think, at this point, right? I mean, kind of we see what's ahead of us. We're not quite sure. No one can predict how things are going to work out. We all kind of have this strong consensus of like, hey, kind of a choppy first half and a strong second half. Mm-hmm. I was kind of talking to you about this earlier this week where Jeremy Siegel came out and said, with his 196 years of investing or however old he is, says, I'll tell you one thing, if everybody has a consensus view, I'll tell you that is not going to happen. So we'll see, right? But I think what we've seen here so far is that very well could be through, right? We might be looking very closely at a soft landing or coming out of it. And again, to your point that you make over and over is that you don't know you're in a recession, right, until after oftentimes you're out of the recession.
Right.
You have to have 2 quarters of negative GDP growth, and then not to mention you don't get that data for like 90 days after the quarter really with all the revisions, and so you're like, oh, we were in a recession, so you didn't really know.
Yeah, exactly.
So what are some of the tailwinds that are making you confident that this is going to be kind of a soft landing? And then let's talk about some of the headwinds we're facing.
So I think biggest tailwind in my mind is what happened last year. We saw the Fed needed to pivot pretty drastically to get inflation under control.
Yeah.
So increased interest rates by 400 basis points. We went from a 1/4 point on Fed funds rate to 4 1/4 on Fed funds rate. Not only did they increase the Fed funds rate, But if we think about what they've done with their balance sheet over the last 10 years, the Fed balance sheet has increased by about $9 trillion, which has helped asset markets and kept bond yields low. We're now at a point in time where they're actually reducing the size of that balance sheet.
Yeah.
Right, to remove some of the stimulus.
Though. That's a headwind.
Right.
Yeah. So now
I'm getting ahead of myself.
That's fine. Let's go there, right? So they are. So okay. You're saying that they did a lot of we'll stick to the tailwind. So they did a lot of this, and I think, we had a Vice Chairman, Lael Brainerd, came out today with some comments on inflation that sounded pretty dovish, right? And saying that, hey, we've kind of we did a lot of the heavy lifting. We're gonna have to keep kind of the Fed funds rate high, keep policy restrictive for a while, but we're kind of waiting to see what happens, right? We have to kind of let the ripples kind of go throughout the economy and see, that maybe they've done the heavy lifting, and markets really like that.
The Fed knows that what they do impacts the economy only after a certain amount of time. So they're really cognizant of the fact that the impact of what they do today might not be felt for a quarter, for 6 months. And I think the headline inflation number was 6.5% year over year in the last report. But if you look at the month over month data and say, okay, great, over the last 6 months, what has inflation been? And then annualize that out as the run rate, we're at about 2%. We're right around their target.
Wow, that's incredible. Because I was taking note of some of the comments in her speech today, and she did mention that 2% mandate. So a lot of people are hoping maybe they get normal in the 3 to 4 range, and so it came out, and she's pretty dovish, right? So she must be seeing some of the same data you're looking at too. So seeing that this 2% is kind of there, and camps are very divided, by the way, of like where the Fed is, right? Kathy Wood's on the other side saying they're going to send us to the Great Depression if they keep this policy restrictive. Of course, it benefits her portfolio significantly if they swing the other way, but hey, that's her view, right? And some of this data is saying, now Brainerd is one of the most dovish central bankers, right? And so you kind of expect some of the dovish stuff, but there are some hawkish things about how they have to stay tight, and they have a mandate for this 2%. A couple other things though that she said, which isn't really dovish on Fed policy as much as good news maybe for the tailwinds you're talking about this soft landing. One thing I took note of is she mentioned the dual mandate. I haven't heard the Fed talk about a dual mandate in a while, right? Wasn't that interesting?
Yeah.
So the dual mandate, right, is inflation and employment. And they have forgotten the latter. They said, nope, we are going to cause, Powell is saying we are going to cause pain. We're going to cause
whatever
harm,
the cost.
Whatever the cost. You're going to lose your job. Too much employment. I got to keep, I got to raise unemployment. So now we're talking about, she said the Fed can now account the risks around our dual mandate goals because of the restrictive level that they've had and because of the effects. So, okay, that's starting to shift where they think that the inflation might start to be coming under control, and they want to start looking like, okay, we're listening, Kathy. We don't want to send ourselves into a depression.
Right.
Yeah. And then also, I'll just read the one quote. It remains possible that a continued moderation in aggregate demand could facilitate continued easing in the labor market and reduction in inflation without a significant loss of employment. It's good news. What is she saying there?
So she's in the soft landing camp, right? She believes that the Fed will do its job and control inflation and control it to a level in which they meet both of those goals, to get inflation under control, but also keep employment and the economy relatively strong.
Yeah, it seems like it. So if inflation comes down, then we're in the soft landing camp, and we got to keep going. All right, and that's good news for your fixed income portfolio, certainly, which we've talked about a lot. Obviously, the same side of the equity stack that we've been talking to, where we want to position our portfolios.
I think one more tailwind to throw in there, if I may, is this one tends to be a little bit more conceptual, but oftentimes the best time to invest is when people are the most fearful. Yeah. If we look at where sentiment is now, there's a lot of really negative sentiment out there, both among, I think, retail investors, consumers, and professional investors. So oftentimes you want to start getting more aggressive, more constructive during those periods of really negative sentiment.
Yeah, absolutely. So that's kind of what we're arming folks with here, right? Here's all the data, right? And certainly just when the economy seems worse is when the stock market gets better. So maybe we saw it at its worst. Maybe there's more to come. Not quite sure, but we do know that bear markets don't last forever.
Right.
And actually they're relatively short.
Right.
Bull markets last on average a long time, right? These kind of dips in a bear market in the economy where the stock market's going down. We have a long way to go to get back to our peak, and so we still have a lot to get back to. So people, when they're at the bottom, they're looking at last month's high or whatever, but just remember how high we were. What we were 4,700 or whatnot.
Yeah.
So we kind of have a long ways to go.
Yeah.
And so you're pretty deep down in the trough at 20%, at 24.6. I mean, that's significant. Like how much worse does it have to be before you become a buyer? But hey, you got to have a strategy to stay in the game and a roadmap to play the game in the future.
And maybe the next 10 years looks different than the last 10 years, right? We're not saying that you need to buy the same things that worked the last 10 years.
I think we're saying pretty significant. At least our last few podcasts, our last year of podcasts has been, it's different. Throw out your old playbook, and this is just going to be a new year, 5 years, 10 years, of course.
We've said over and over that this is the most important time to look different than the S&P 500 as the benchmark, and think that that's certainly playing out in what we've seen over the last few months.
Be disciplined, be balanced, be different. Absolutely. 3 principles. We'll keep talking about those. So tell me about some of the headwinds, though.
So headwinds, I think, right, we've seen, if we look long term, look over the last 10 years, we've been in an extremely low interest rate, low inflation environment. So to your point earlier, what assets do the best in that kind of environment? It's those long-term growth stocks. The U.S. tech stocks have been the best performing asset class over that period. I think that we're going to be in a different environment going forward. No more do we have this inflation that's much too low. We think that we're probably not going to see a 9% handle again, an 8% handle, a 6% handle. But will we settle somewhere in that 2.5% to 4% range?
Yeah, I mean, I was thinking that as you were describing the last 6 months of where we are in inflation and kind of what the Fed's going to have to do. And this isn't like, oh, we got it to do. We're all back to the old ways of doing things. Like, this is going to be a gas and a brake and a coast and put it in neutral and brake and gas. And it's going to take a while, right?
Yeah.
To kind of, a soft landing is hard to manage. It's like a delicate balance.
Yeah.
Right? A hard landing is like, clean up the rubbish and build anew.
Yeah, exactly.
Soft landing takes a long time, right? To make it to just that delicate work of, inflation's creeping up. We have to do, I thought we were over this.
Yep.
And so you're going to see volatility in asset prices. And some of them swing much more than the others.
Yep.
Long duration bonds are going to swing a lot more to interest rates.
Yep.
Right? Long duration stocks, meaning growth and tech stocks, are going to swing a lot more with high inflation.
And that transition might be painful. The International Monetary Fund, the IMF, does a study of what they call zombie firms. So companies that don't have enough earnings to cover their debt service ratio. So love to use a personal example.
They just need to raise their debt ceiling, man.
Yeah, piece of cake. But if it's you and me, right, we're saying, hey, I don't earn enough money to pay the minimum payment on my credit card.
Yeah.
Not a great fiscal situation for me to be in. Yet these companies were able to survive for so long because interest rates have been so low. They just say, I'll just open up another credit card and use that additional credit to pay what I owe on my first credit card.
Right.
Doesn't work so well in an environment where interest rates are now a little bit higher, where that debt service increases, and where lenders aren't so willing to offer that credit.
Right.
So are we going to see a little bit of a rocky transition from some of those growth-oriented companies to the more fundamental, more cash flow-oriented value companies? Yeah, probably.
Yeah. That's why you need recessions. You need these things to shake out those so-called zombie companies, right?
Recession isn't a bad word. It's a normal part of the business cycle.
Yeah.
You just need to prepare for it and have an action plan going into it, which I think is the value of what we offer to our clients.
Yeah, absolutely. So then looking forward, so you also have the headwinds though that you started to talk about, and I cut you off on. The Fed is and Brainerd did even talk about this too, but you talk about, well, the Fed's still unwinding their balance sheet. So talk me through that a little bit as our kind of final point on some of the headwinds that might cause some disruption to the soft landing.
This one gets a little wonky, so I think it gets underreported in financial media, but I think it's worth taking some time and kind of walking through. So we've all heard of the QE programs, the
Right.
quantitative easing. We've gone through 4 official, 5 if you include the post-COVID quantitative easing, where the Fed only started using its balance sheet to support financial markets after the 07-08 crisis. Since then, the Fed added over $9 trillion in assets to their balance sheet. So operationally, what this looks like is the Fed makes this money available to the banks in the Federal Reserve System, hoping that those banks will then be more inclined to make loans to corporations, make loans to individuals.
3 to 5 trillion was to make the bank solvent, right?
Right.
So that just had to go and sit in a vault, and then they raised the requirements and they said, here's some money and you have to hold on to it.
Right.
And then they said, okay, start lending.
Right.
And like, well, you said we have to hold on to all the money, so they had to play that dance a little bit.
Right.
Give them some more money.
Right.
It took a long time to start lending.
Right.
Then it started to really work.
They started lending.
Yeah.
Which led to inflation.
Right. And then we had COVID.
And then we had COVID.
And then that was another, 3.5 trillion added to that was a 50% jump in the Fed's balance sheet.
Yeah, exactly. We went from 4.5 to over
double.
8.
Yeah.
Yeah.
Okay, so now they are pulling the money back.
Pretty aggressively. And not only the Fed, but if you look at the ECB, the Bank of England, the Bank of Japan, they're all engaged in these operations where they're trying to say, okay, guys, we made all of this accommodation available for you for so long, but the precondition to that was inflation stays low.
So, I've had this long-running analogy about Powell and the Fed on this show of, Dad cutting off our allowance, right, and saying, hey, you're going to be okay. You got through your schooling and so forth, and so now you're on your own, kid. Go make something of yourself. Say, oh my gosh, it's really hard. He's like, yeah, I know, it's hard, but you got to go make it.
Stand on your own 2 feet
Right.
at some point in time.
And we're all like, yeah, he'll let us, sleep in the guest room or sleep in the garage if things really get bad. And they're like, no, you're really on your own. So the markets were like, how accommodative is the Fed to us? And so, we kind of see that dance where it's like, okay, their interest rates are higher. I'm going to have to pay for things. So I have to kind of do it myself. But, the unwinding of the balance sheet is more like, hey, that allowance I gave you the last 10 years? I want it back. So they're sucking money out of the economy, which also increases interest rates on the long side. And how much are they doing right now?
So we're going $65 billion a month.
It's going to, 120 later this year.
Yeah.
So $120 billion a month later coming out of the economy or coming out of our money supply. So that's going to have an effect on the ease of lending and doing business.
The Double Line put out a really great chart, Jeff Gunlock, where he overlaid the mega cap stocks, the Googles, the Amazons, the Netflix, over the size of the balance sheet, and it fits almost perfectly. Where as that balance sheet goes up logarithmically, goes straight up, those companies go straight up. As it starts to level and fall off, which it did last year, you've seen what's happened to tech stocks.
And those companies are a really good barometer of the economy, right? Because they're kind of communication, it's retail, and it's advertising. If you look at Google, Apple, Amazon, right? Netflix, entertainment, like where do people go to like spend their money when things are good? And like those are the stores, right? Where people are spending their money. And then, so all of those things are going to go really well in the economy as well, right? But if we're pulling money out of the economy and it's harder to do business, right? That it's not as easy for those companies to make money.
Yeah.
So we do see a weakening of the consumer as that bond buying program keeps going.
So I think big picture here leads to slower growth.
Bond selling.
Right. Yeah. The Fed has stoked growth through what they've done through their balance sheet, but now we need to stand on our own. So will likely lead to slower growth and slightly higher rates. There's a call.
There it is. All right. I like it. Okay. I don't know how much I like that end. But there are headwinds, lots of tailwinds. We got to stay in the game and have a game plan going in the future. But I think the tenets of, be disciplined, be balanced, and be different still really play true. We're seeing it play true. We're looking at fixed income in our portfolio. We're looking at international. We're looking at emerging markets. We're not just looking at growth. So get a new game plan, okay? You got to be different than where you were before. You got to have a balanced approach for stocks and bonds. And you got to be disciplined during these turbulent markets that it's really uncertain, but usually uncertainty at its highest is the best time for us investors to get in. At least stay in. Don't get out. All right. Good show. Keep it rolling. Back in a couple weeks here on the Presidio Perspective. I'll be here. You going to be here?
Absolutely.
All right. David, you going to be here? Thumbs up. All right. Have a great day, everybody. Thanks for tuning in. See you next time.